January 2020 to January 2022, I turned $19,000 into $89,000. This is my Roth IRA, and I use small account option trading strategies that I'm going to teach you today to achieve these results. In my Roth IRA, I did not add a penny to the portfolio as I had a high income out of college on Wall Street, and Roth IRAs do have income limits that I surpassed with my total income. So these are my no BS results. As usual, I always show you my receipts and my results because I'm fully transparent on this channel. So basically, I was able to 4.68x my small account portfolio in just 2 years, almost a 5x return. I believe after you watch this video, anyone will be able to have a full path to achieving similar results if you watch through the video. In fact, the lessons that I learned in the past 2 years crushed the trader that I used to be. So what that means is you're going to be able to copy and paste these strategies and my learnings for yourself. I'm packing everything I have into this video. All I ask is that you like the video. It really helps out my goal of helping as many people master and learn option trading as possible. If you want my buy and sell alerts, I have a Discord community where we annualize 70% returns in 2021, and I plan to keep that pace going. I will also drop my small account option playlist for further study for you in the description. Let's not waste any time and jump into getting stupid rich with Uncle Henry. So first off, let's discuss risk management. If you have a small portfolio, most likely you don't have another small portfolio just sitting there as a spare tire laying around. So that means for sure you want to grow one portfolio, you need to grow it fast. However, you can't risk losing it. Well, I completely understand that because I grew up poor. I started with a small portfolio and I was very afraid of losing the money. I worked for pretty much my whole life to make even a few $1,000s in the very beginning, early stages, and it was very important for me not to lose that first few thousand. We also know Warren Buffett's rules. Rule number 1, don't lose money. And rule number 2, well, look at rule number 1. You cannot lose money. Proper risk management will help you protect what you worked for while still giving you the proper opportunity to grow the accounts quickly. Proper risk management helps cut down on losses. It's an essential but often overlooked prerequisite to successful option trading that really nobody else covers because they don't have any institutional experience or a finance degree to understand proper risk management. Rule number 1, this is called the 1% rule. A lot of day traders follow what's called the 1% rule. Basically, this rule of thumb suggests that you should never put more than 1% of your capital or your trading account into a single trade. However, I'm going to modify this because we're working with small accounts. If you have $10,000 in your trading account, your position in any given option shouldn't be more than $100. However, to grow my account, I had to break this rule because I started with less than $5,000. It was not feasible to use some of the strategies I will cover later in this video if you follow that rule. Instead, what I did was I upped it to 5%. So you can absolutely make this work, especially if you do plenty of research on your trades and only invest in high conviction trades. Warren Buffett referred to this as the punch card. Pretend that you only have a punch card with about 20 trades. Now you can't make any more after that. So that will make you very careful on what stocks that you pick. So with this rule, 5% of $5,000 is only $250. Now that's something that you can really work with, and I have strategies for you. But first, let's talk about rule number 2. Rule number 2 is setting stop loss and take profit points. Now, very important in risk management to have a proper plan and not get greedy. A stop loss point is the price at which a trader will sell a stock and take loss on the trade. With options, it's the point where you want to close that option position. I'll discuss this when I go more in detail into strategies, but absolutely important to understand the whole picture, not just the strategies. Money likes patient people. It's often the case that traders take action way too fast. You want to let your profits ride further and really ride those profits into 2, 3, and 4x territory, because even small trades where you make a significant 3 or 4 or 5x potential gain, that's going to really move the needle on your portfolio. Now, I view letting your winners carry you as a very high priority, just as important as it is to have a stop loss in place if a position goes down 50% against you. It's important to maximize your gains, make as much money as possible, but also to minimize your losses. This often happens when a trade does not pan out the way a trader hoped, and they end up panicking and losing way too much money, or they end up selling a position way too soon and not riding it higher. Too many traders traders start to panic. But if you set a stop loss ahead of time when you open the position, now you have a plan and you won't panic, or at least you won't panic as often as other traders that don't have a plan. On the other hand, a take profit point is the price at which you need to sell the position and take a profit on the trade. This is when the additional upside is limited given the risks. I'm going to show you what that looks like as well in this video. For example, if a stock is approaching a key resistance level after a large move upwards, say the RSI, the relative strength index, is at 80 or higher, then I look to close out on that position and take a profit, because at 80, the stock has become too hot and there is no more further potential, or your further potential is very limited, so the risk is going to outweigh the reward. Then also say that the stock dips below the 60 or 90-day moving average. That's a bearish sign, and if I have an option position that can get hurt, I close it out early before I encounter any additional problems. Now, this is also the case if RSI goes below 25 or even around that 20 level. That's why the best traders have both speed and they also have patience. This is hard to learn, but I know, yes, you watching this channel, you can do it if you focus and have a proper plan when you're trading. Now, I do want to discuss platforms. I've used Thinkorswim, Webull, and Robinhood. In client accounts, when I was working in financial advising, which I don't anymore, I've seen so many people have Fidelity and many other brokerages as well. Now, I used to work in financial advising. I've looked into many client accounts and I've seen other platforms like Fidelity and many others. Now, the broker is important in some cases. I've taken 3K into 10K on Webull. I've been with Robinhood for a while now and I've seen most of my gains on that platform. And also TD Ameritrade has some of the highest amount of customizations, and it is one of the best platforms for advanced traders. Personally, Webull and Robinhood have the most simple user interface, and they have done the job just fine for me. Webull has some really low margin rates, as does Robinhood, and once you've had a lot of experience and you've also had lots of wins, then cheap margin rates are very helpful. Not recommending margin for everyone, because obviously you have to become a confident and profitable trader before you end up using margin, because it can be one of the riskiest and most dangerous things, especially for beginner traders and even medium experienced traders. I also like the simplicity because Robinhood and Webull tell you chance of profit and have very nice payoff charts right in the app. So let's move on from platforms. If you do want 5 free stocks though, I'm gonna link you guys Webull in the description, as well as Robinhood for a couple free stocks. Now let's jump into specific strategies. All of these strategies I will show you require less than $500 worth of capital. So you can trade on a budget and not risk too much money on any single one trade, because that's poor risk management. Now I'll be honest, if you have a $3,000 portfolio, you can go for a $500 position. This is not financial advice, but I do believe that if you have high conviction in a single name, it is okay to break some risk management rules. Just make sure that you don't break the rule too many times and end up with, say, 5 large positions, as that is not going to be enough diversity. Now, strategy number 1, let me go ahead and share my screen and let's go over all the different strategies that you can use to grow a small portfolio. Strategy number 1. With this strategy, I'm going to show you it's a rare case where the return is actually better and juicier than the title of my video, which is extremely rare because most YouTubers clickbait, and I'm actually under-promising and going to over-deliver with this trade on BBBY, triple BY, Bed Bath & Beyond. This trade is going to have the potential to turn $3 into $50. Very small account trade, someone with $20 in their pocket could make. Obviously, you want to manage the risk on the trade I'm going to show you, but I think that you can do this on a number of different stocks. Let's take a look at the technical analysis first and why I'm choosing Bed Bath & Beyond. So taking a look at the technical chart right here, I'm going to the 6-month chart. And if you guys notice here, this stock has pulled back tremendously and it has bottomed out in this period from October 5th all the way until the end of October. So during this entire month, this stock has stood still essentially right at $14 per share. And then Bed Bath & Beyond rose up to $23, followed by a pattern of a decline again. And if you notice right here, we're sitting right at the bottom of the Bollinger Band, but this stock has honestly not had much movement for the past month and 10 days. Since December 1st, this stock has been trending lower. It has gone down to $13 per share, but it has done so in a very predictable way. And currently $13 per share is this hollow point right here where the stock had a complete bottom out and did absolutely nothing. So I have a big feeling that Bed Bath & Beyond can have this similar pattern right now and repeat the same process. So the strategy that I'm going to show you, you don't have to do it on Bed Bath & Beyond, although I'm going to do an example on it. You can do this on any stock that looks like it has a predictable pattern where it had a previous stall. That stock might have went up, it might have went down, and then it continues to stall and consolidate going sideways. Strategy I'm going to show you really takes advantage of any stock that is not moving that much. So keeping in mind the current stock price is $13 per share, this is going to be very important for picking the strike price that we're going to sell an option. So I'm going to go to trade Bed Bath & Beyond options, and currently it's January 10th. I'm going to go 1 month out. You can do this strategy going 1 week out, you can go for 2 weeks out, or up to 1 month like I'm going to do right now. It really just depends on the different option that you're looking at. However, 30 days is a very good time period for me, but oftentimes I do see students being very successful with going much shorter. So the first thing that you want to do to open up this position is you want to click sell call option. Now the call option, the first one that we're going to sell, this is going to be your max profit strike. So for example, going back to Bed Bath & Beyond, I am looking at the stock and it's currently sitting at $13 per share. Sure, we have had a big downtrend, but I believe this stock is basically going to just start trading sideways. I mean, literally just sideways between maybe $12.75 up to maybe $13.25. I think we're going to have a very tight range of trading. Therefore, I'm going to pick the 13 strike because that's the current price of Bed Bath & Beyond. Because the stock is currently at, $12.98, I'm going to go ahead, sell this $13 call option. Now, what you want to do next is you want to go back and click buy call option. So now this is going to be a very small trade that's only going to require about $3 and give you the potential to make about $50. What you want to do as a step 2 is go 1 strike below. So now I'm going to buy the 12.5 call option. As well, I'm going to do a second thing. Now I'm going to buy a call option above the strike that we sold. So now going to 13.5 strike, I'm also going to sell this call option right here. All right, taking a look, volume is 11, implied volatility is super high. These are just some of the reasons that also add up to being really good, because higher volatility is actually a good thing for most option strategies. So I'm going to go ahead and buy this call option right here. So now I've opened this 13.5 call option right here, but instead of having this order right now, I'm actually going to click this drop down arrow on Robinhood. You can do this on Webull or a number of different applications. Again, I prefer the simple interface that Webull or Robinhood has. I'm going to add both of those links in the description for you guys. So going to custom set a unique ratio. This is what you want to click, because what we're going to do right now is we have 2 buy options right here. However, we only have 1 contract for the sell option at the 13 strike. So I'm going to change this 1 contract to 2 contracts. And now this is where things get really interesting, because this beautiful chart right here, I want to explain to you exactly your payoff. And if you'll notice right now, your total cost is only $2. So let's scroll down. This chart already looks beautiful. What I like right off the bat is take a look at this green area. This green area is all of the profit that you could be making, and this red area is where you can lose money. Now the green area is much bigger than the red area, and if I continue to scroll down here, you will notice that the max loss for this trade is $3. However, your max profit is $47. So with this strategy, you can turn $3 into $50 total for a profit of $47. Now, currently the stock is $12.98. You make your max profit right here at $13 per share. Again, this is a strategy that's going to really rely on the stock standing still. It needs to trade within a very tight range. For example, your profit area is going to be right at $12.53, which is just $3 away from your break-even price of $12.50, which allows you a lot of margin for the stock to go down to $12.53 before you see any losses. Now, your only loss on the downside is going to be between $12.53 and lower. So if the stock goes below $12.53, you have the potential to just lose the $3 that you put up for this trade. Now, on the upside, your break-even point, again, is going to be $3 below the strike which you sell. So rather than 13.5, since you're spending $3, your break-even price is going to be $13.47, as you can see on the screen. Now, anything above that, you can lose the $3 that you're putting up for this trade. However, this is a trade that I think is going to benefit almost all smart portfolios to at least incorporate because of the big return potential. I mean, if you can turn $30 into $470, that's going to do wonders for your portfolio. However, you need to do your research and pick a stock that is going to be trading in a very tight range. For example, Triple BY is a good example that I am looking at. However, I'm not a financial advisor, so make sure that you do your own research. All right, right, now I want to show you something else that's going to boggle your mind. It's the same strategy, but it's a complete anomaly when I take a look at Amazon stock. So taking a look at Amazon, I think Amazon's another stock that does trade a lot sideways. So I took a look at the same trade on Amazon and things really didn't make sense. It almost seems like you can make unlimited profit. Let me show you what I mean by that. If you do sell call option, I'm going to sell the 3240 strike right here. I'm going to sell this call option. And again, same process. I'm going to buy the strike below, and I'm also going to scroll up and buy the strike above. So buying the 3230 and buying the 3250 while selling the 3240. The only thing that you need to do now is go back to the drop down arrow, go to custom, set a unique ratio. And again, we're going to sell equal amounts of call options as we're buying call options. So I'm going to end up selling 2 call options and, buying 2 call options as well. Now, if you'll notice this is pretty crazy, guys. Take a look at the chart. There is no red area. It's just green. Literally, your max profit is $1,008 and you don't actually have any max loss. So this position right here is something called arbitrage. It's where you have a free lunch. So this right here is called arbitrage. It's where you actually get paid for finding an opportunity. This right here is showing a max profit of $1,008. However, the max loss is non-existent because you're actually collecting a credit of $8. And if Amazon ends up being right at $3,240, you'll end up actually making $1,000. Now, of course, you can make amounts in between. If Amazon ends up closing a little bit lower or a little bit higher, you can make something between $8 and $1,008. Now, quickly, why I wanted to show you this trade, because it's very interesting, but I also know a lot of people are gonna say, wait a second, why doesn't everyone just do this? If this literally has no risk and only upside, then wouldn't everyone just take this position themselves? Well, actually, something that is not being calculated, but I think is a really good lesson, and you guys should look into doing these trades on different types of stocks, is that Robinhood isn't really accounting for the bid-ask spread. So the bid-ask spread here is very, very wide. So when you actually end up trying to open this trade, most likely you are not going to be able to collect $8. In fact, you may even have to pay a little bit of money. It just depends on the bid-ask spread. Because it's so wide, you may not get filled for the $8 credit. In fact, most likely you're going to be charged a little bit of money. However, it's not bad to look at these trades because some of these trades could actually be very close to a zero cost. However, it's unlikely to happen because option market makers and other traders are aware of arbitrage opportunity, and they're usually not commonly found in the market. But it's super interesting because I do bet that you can find positions that are like $2 or $3, but give you even more reward than the $50 that I just showed you on Triple BY. All right, strategy number 2. This is where the potential 5x baggers can come from. With this strategy, there is a sweet spot similar to the first strategy, but a lot less exact. So there's a lot more flexibility with this second strategy. The strategy is a long call spread, or what I like to call when I was working on Wall Street, the bull call spread. It's a little more advanced, but I'm going to explain it to you and water it down to make it really easy. And honestly, it's one of my best strategies in my toolkit. A bull call spread means that you buy a call option, but rather than just spending money on a call option, you can finance it and pay way less upfront by selling a different call option. Let me show you this on a play with Chipotle. Now, taking a look at the Chipotle chart, I think we're in a very interesting position for this company because specifically, there's a lot of inflation going on right now. Restaurant stocks are not doing too well, and many of them are selling off. For example, over the past 6 months, Chipotle has been very predictable and has had very consistent trading volume. I mean, this stock has basically stayed right around $1,800 per share. You can see right here that the moving average has sustained since October right around 1800 before it started falling down to 1722. This stock has only recently pulled back below its moving average quite significantly. So for me, I believe this is a buying opportunity despite them raising their prices. I mean, last time I visited home in Philadelphia in the US, I was obsessed with Chipotle. I pretty much went every single day and I love the food. I think so many other people feel the same way, and that this stock has sold off, but I don't think it's warranted. So what I believe with the second strategy that I'm going to show you is that Chipotle has a significant potential to pull back up to about $1,700 per share. Now, this might not seem a lot. However, with options in the bull call spread, you can potentially 2x, 3x, or even more using this strategy on a stock that doesn't even have that much volatility. That's the beauty of it, especially with something like Chipotle. We're going to take a look at the options right now. I'm going to show you what I mean. So what I'm going to do, because I do need some time for my thesis to play out, I do want to go out about 60 days from today's expiration. position. So I'm gonna pick March 18th. Of course, if you're watching this in the future, just pick a 60-day option on the stock that you think that this is going to be a good strategy on. Now for Chipotle, it was a $1,700 stock at the end of the year, and in just 10 days, it has pulled down about $100. So given 3 months, this is ample time. This is more than enough time for the stock to recover back to 1,700. In fact, it can happen way faster, but just to be safe, I am going to still pick the March 18th date. However, I can probably pick the February 18th date as well, but we're just gonna go for March just to be super safe. Now, Chipotle is currently trading for $1,525. So with the bull call spread, what you wanna do is you wanna buy a call option that is at the money or near the money if you're very bullish on the stock. So what that's going to look like, I'm going to purchase the $1,530 strike right here. And if you'll notice, buying this call option is super expensive. I mean, ridiculously expensive, and not everyone wants to go ahead and spend $9,730. So what the bull call spread does is greatly decrease the total cost that you have to put up for the trade, and it also still has a lot of benefits. So I'm going to click sell call option, and now I'm going to sell a call option that is a little bit more out of the money. So I bought the 1530, I can sell the 1535, the 1540. That's going to be $1,000 spread. However, I want to make a $2,000 spread. However, because I think this stock can be $1,700, I want to go a lot higher. And in fact, just to be even more conservative, I'm only going to sell the 1,600 call. So now that I have clicked sell the $1,600 call, what you guys will notice right now is I've opened up a call debit spread or a bull call spread. Both of them are the same thing. All right, so if you'll notice right here, the total cost has gone down to only $33 rather than the $97. So you basically have a discount of 2/3 off of the price. Rather than paying nearly $10,000, the total cost is only $3,300, and your total reward is going to be $7,000 here. However, what I actually want to do to make the math even easier, because I'm opening up a $1,530 call option, I want to sell the 1,630 call option so the math is even easier. So here you can see that the total spread here is going to be $10,000. However, your total cost is only going to be $4,475. So this position right here can turn $4,475 into $10,000, or slightly more than a 2x return in just a couple of months. Now, I do want to show you guys how to buy a bull call spread on a cheaper stock, because Chipotle is pretty expensive. You have to put up about $4,400. However, you can pay a lot less for a shorter term call option on a cheaper stock. For example, I'm going to buy a Palantir $17 call option right here at the $17 strike, and I'm going to sell the 17.5 strike right now. What you'll notice is now the total cost of this trade is just $18, but you have a profit potential of $32. In this example, you nearly have a 3x on your money, because 3 times $18 is $54. So this is nearly a 3x trade on your money. All right, the third and final strategy that will help a small account grow in 2022. This is one of the best strategies. It's very popular. It's called the poor man's covered call. Now, taking a look, the stock that I want to analyze is Alibaba, ticker symbol BABA. The reason why I'm looking at Alibaba is because this stock was a $200 stock. However, a lot of stuff happened in China. People are scared of the stock right now. People have sold off. I don't necessarily recommend holding a lot of shares. You're going to be tying up a lot of capital. So instead, I want to recommend a poor man's covered call on a stock that you don't want to invest a lot of capital into, but you want to have exposure into. So Alibaba has seen a huge sell-off. However, the stock didn't really go below $107 per share, and currently I think there's a very strong support at around $110. This stock is currently trading for $128.30, and I think a poor man's covered call is an interesting strategy to at least consider on BABA, or another stock that has had a tremendous sell-off but is too risky for you to dump a lot of capital into. So taking a look at the BABA option chain, what I'm going to do, because a poor man's covered call, instead of buying shares, you're buying a leap option. So I'm going to go out for January 20, 2023, and now I'm going to buy a leap option that is near the money. Now, textbook delta for a leap option when you're doing a poor man's covered call is going to be about a 0.9 or a 0.8 delta. However, something that I do is I go a little bit riskier. So I usually go for about a 0.8 delta, or sometimes even a 0.75 delta, because I believe it's just as good. I mean, no other person really shows data or the actual trade over many, many years. And that research is really hard and expensive to get your hands on. It's usually big institutions. However, if I was going to make a bet, honestly, a 0.8 delta is going to perform just as well or even better in terms of return than a 0.9 delta. So what I'm going to do right now on this trade is I'm going to go ahead and buy the 90 strike option for $4,983. So rather than buying straight up shares, which will cost you $12,000, you get more than a 50% discount. Now what I'm going to do is I'm going to click sell call option, and with a poor man's covered call, you can sell weekly options, you can sell monthly options. You can now treat this as a covered call position without having to have 100 shares of the stock. So now you can go ahead and sell the 140 call option right here, and now you can start collecting monthly income. The poor man's covered call is a fantastic strategy to have in your portfolio, but there is a lot of nuances and things that you have to know. So if you really want to master the poor man's covered call, I made a video, I'm going to link it in the description, and you can also watch it right here on the screen.